I've been around long enough to watch the same movie play on repeat, and every time the trailer looks brand new. In 1999, the newspapers screamed, "New economy, profits don't matter anymore." By 2006, it was, "Real estate never goes down." In 2017, every Uber driver had a favorite coin. And just last year, I heard a kid at the airport explain that Nvidia would double forever because, quote, "AI is everything." The actors change: .com, condos, Bitcoin, chips. But the plot never does. Get rich fast, borrow if you have to, and trust the crowd because this time is different. I've seen that film so many times, I can mouth the dialogue, and the ending credits always roll over retirement accounts that look like crime scenes. The hardest part isn't predicting the crash. It's convincing people they're in the middle of a mania while the confetti is still in the air. When your barber starts pitching you a token you can't pronounce, the market isn't handing you an invitation. It's sending you a tuition bill, and the classes start tomorrow. Easy money, they call it, as if the dollars come pre-warmed and folded. The phrase itself is a sales pitch, not a fact. I've watched brokerage apps turn speculation into a video game. Swipe up, swipe down, confetti emoji when you buy, and a quiet red number days later when the confetti turns to sawdust. Social media does the rest. A stranger in a rented Lamborghini explains how he turned $1,200 into a beach house, and suddenly your steady paycheck feels like a prison sentence. What they never mention is that the same guy rented the Lambo for the afternoon, and the beach house is a stock photo. The only verified part of the story is the affiliate link below the video. The human mind is wired to hate missing out more than it hates losing money. So we leap before we look, and the leap feels heroic right up until the ground arrives. I don't blame anyone for the impulse. I felt it too when I was 25, and every tip sounded like a shortcut to the life I wanted. The difference is, I had a mentor who grabbed my collar and said, "Warren, if you can't explain where the cash will come from in 10 years, you're not investing. You're donating to whoever sells before you do." I've had a front row seat to human greed and fear since Truman was president, and the scenery never changes, only the costumes. In the 50s, it was uranium mines. The 60s had conglomerates that added tronics to their names. The 80s gave us portfolio insurance that insured nothing, and the 90s handed out eyeballs instead of earnings. Each time, the crowd convinced itself that old rules were obsolete, and each time, the old rules quietly cashed the check. I remember a dinner in Omaha in 1998 when a neighbor bragged that his AOL stake had tripled since Christmas. He spoke about page views, the way a farmer speaks about rainfall, as if the sky had rewritten physics. By 2002, he was mowing his own lawn again because the landscaping crew cost real money. He wasn't foolish. He was human, and humans are built to extrapolate straight lines until the graph punches them in the nose. The reason I survive those cycles isn't superior IQ. It's that I figured out earlier than most that the market is a thermometer for emotions, not a barometer for facts, and emotions spike fevers faster than any virus. Let me take you back to 1999, when websites were worth more than the factories that made the servers that ran them. I sat in meetings where analysts valued a startup at $400 million because it had 2 million unique visitors. Yet the company's only inventory was a breakroom espresso machine. I asked politely how many dollars of cash those visitors would send the owners over the next decade, and the room looked at me the way teenagers look at a parent who won't let them borrow the car. The NASDAQ doubled in a year, and the newspapers declared me washed up because Berkshire stock actually went down. Owning brick plants and insurance stubs was so last century. My partner Charlie told me, nothing sedates common sense like a crowd chanting new paradigm. We kept buying the sleepy, the mundane, the profitable. When the index finally fell 80% from its high, the chant changed to, "Why didn't anyone warn us?" And I was still holding the same boring businesses that had been sending me cash the whole time. I had a friend, let's call him Greg, who day traded from his den in jeans and a bathrobe, and by late '99, the robe had golden threads because everything he touched turned to multiples. He told me, "Warren, I'm sorry, I can't assist with that request." I smiled because I'd heard the same line about color television. Greg's biggest position was a web portal with negative gross margins, but the stock doubled every quarter, so the math felt irrelevant. He refinanced his house at 125% loan to value and poured the proceeds into call options because, as he put it, I can't lose. The first quarter of 2001, the company missed estimates by a mile. The stock opened down 40 points. And the options expired in the same week his employer handed out pink slips. The last time I saw him, he was delivering pizzas to keep the lights on, and he apologized for not being able to split the check. I didn't lecture him. I just remembered that the market collects its tuition in cash, not sympathy. Fast forward to 2006, when houses turned into lottery tickets you could live in. I toured a subdivision in Florida, where a dentist owned 5 condos for flipping, each financed with 95% debt and a teaser rate that would reset in 18 months. He explained that prices had never fallen in that zip code since records began, and the broker had thrown in a free lawn chair at closing. So really, what was the risk? Across town, a strawberry picker with a $30,000 income had just been approved for a $700,000 mortgage because the lender simply assumed the home would appreciate faster than the interest compounded. Leverage, that silent assassin, made every homeowner feel like a mogul and every banker feel like a genius, until the resets hit. The payments doubled, and the same leverage turned a 5% price dip into a foreclosure tidal wave. By 2009, the dentist was mailing keys back to the bank. The picker was couch surfing, and the lawn chair was the only asset still sitting on the sidewalk, awaiting the next rain. Then came crypto, the new gold rush without a map or a sheriff. I don't dislike innovation. I've lived through the refrigerator, the jet engine, and the smartphone. But I do dislike buying something I can't value just because it went up yesterday. In 2017, I listened to a recent college graduate explain that Bitcoin would replace gold, the dollar, and apparently gravity itself. He had cashed his signing bonus, maxed 3 credit cards, and mortgaged the future of 3 roommates, who now followed his Twitter like gospel. When I asked how many transactions the network processed per second and at what cost, he quoted the price chart instead of the income statement, because there wasn't one. The price hit 20,000, then 3, And the same kid tweeted, "The government killed crypto," as if governments had forced him to press the buy button at the top. The technology may still change the world, but that doesn't entitle every token to a permanent bid above zero. And it certainly doesn't make every buyer a profit. Today, the letters on the marquee read AI. And once again, the chorus swears this time is truly, uniquely, cosmically different. I'm 80 plus, and I still read annual reports for fun. So I've seen NVIDIA grow from a graphics card maker into the pick and shovel play for machine learning, and I admire what they've built. But admiration isn't valuation. When a stock sells for 80 times earnings, the market is implying that profits will octuple and stay there forever, as if competition, recessions, and math itself have been coded away. I've lived through enough tech leaps to know that the winners are usually the customers, not the investors who pay peak prices for the hardware. The internet really did change everything, except the fact that capital eventually demands a return. So buy the innovators if you must, but don't confuse a great story with a great price. And please, don't bet the ranch on the assumption that no one will ever build a better chip for less money. Trees don't grow to the sky, and silicon is still bound by the laws of physics and profit margins. Most people don't lose money because the market falls. They lose because they were standing on tiptoe when it did. They buy late, concentrate in whatever just went up the most, borrow against a portfolio they swear can't decline, and then sell in a panic when the margin clerk calls at 3 p.m. on a Friday. The sequence feels like bad luck, but it's a script you can rehearse in any decade. Hype, leverage, concentration, capitulation. I've seen engineers liquidate index funds to buy a single cannabis stock on a rumor from a podcast. And I've seen retirees take out home equity lines to double down on a triple-levered ETF that promises twice the return of a sector they can't spell. When the trade moves against them, they don't blame the gimmick. They blame the Fed, the shorts, the algos, anyone but the face in the mirror who clicked confirm order. The market is a mirror, not a mugger. It shows you your own greed, if you dare to look. Leverage is the silent killer because it feels so polite at the cocktail party. The broker says, "You're approved for 2-to-1, as if she's offering you a second olive. The options tutorial on YouTube promises defined risk, but the definition expands when you roll the position 4 times, and the premium balloons larger than your monthly salary. I've watched a 30-year-old with a stable job lose 3 years of savings in 3 days because he bought NVIDIA calls on margin, and the stock dropped 8%. 8%, that's all. The leverage turned a routine pullback into a forced liquidation. And the same kid who thought he'd be driving a Tesla by Christmas wound up driving for Uber to pay rent. I don't scoff. I remember 1951, when I myself bought a stock on margin and sweated through a 10-point dip that felt like a heart attack. I paid off the loan, vowed never again, and slept better ever since. You don't need debt to get rich, but you do need to avoid it to stay rich. The boring truth is that cash flow pays the bills, while hype only pays the promoters. I own a piece of a soda company that has sold syrup for 130 years. Every quarter, the dividend hits my account, whether Twitter loves cola or hates it. I own shares in a railroad that moves grain and chemicals across the continent. The cars roll and the royalties roll in, no matter what Elon tweets. Compare that to a meme stock that trades at 40 times sales because it might disrupt something someday. If the executives don't sell their own shares first, the meme might triple, but it might also go to zero, and zero doesn't send my grandkids to college. A business that gushes cash can survive a bad CEO, a recession, even a pandemic. A story can survive only the attention span of the crowd, and the crowd has the patience of a toddler on sugar. So I sleep well, collect the checks, and let someone else stay up all night refreshing a message board to see if a stranger still believes. Boring companies build beautiful lives because they free your mind for things that matter. When you own assets that compound while you cook breakfast, you don't yell at your spouse about the grocery bill. When your portfolio doesn't swing 10% before lunch, you can concentrate on your actual job instead of your side gig as a day trader in pajamas. I've had friends lose marriages over secret trading accounts. They hid the losses the way gamblers hide tickets, and the lie became bigger than any market crash. On the other hand, I've seen couples grow old together on a diet of steady dividends and index funds. And the only arguments were over whose turn it was to pick the Netflix movie. Money is a silent member of every family conversation. Make it a quiet, reliable guest, not a drunken uncle who might flip the table. Your brain in a bubble is like a car with no brakes, and a radio that only plays the greatest hits channel of your own greed. FOMO is a neurological hack. The minute you hear that a stranger made more in a week than you make in a year, your amygdala screams, "Get on," or "Get left behind." The crowd feels safe because everyone's smiling, but the crowd is also the only place where $1 trillion can vanish in a day. I learned to walk away by asking one question. If I couldn't brag about this at a barbecue, would I still buy it? If the answer is no, I'm feeding my ego, not my future. The day you feel comfortable being out of step with the cheering is the day you become a real investor. Until then, you're just a cheerleader holding pom-poms made of dollar bills. Before I buy anything, I still scribble 5 questions on a napkin. Do I understand how the cash gets here? Is it already arriving, not just promised? Is there a moat, something that keeps competitors out? Am I paying a sane price for every dollar of earnings? And would I still want to own this if the market closed for 10 years and I couldn't check the price? If all 5 answers are yes, the odds shift in my favor. If any are no, I pass. I don't need a spreadsheet the size of Nebraska. I need common sense and a little patience. That napkin has saved me more money than any algorithm, and it fits in my shirt pocket next to the mints. Maybe you're watching this thinking, "Warren, I already did everything you told me not to do." Good news. The plane hasn't left the runway. It's just on fire, and you can still put it out. Start by listing every holding and circling the ones you bought because the chart went vertical. Those are your fantasies, not your factories. Sell the ones you can't explain to a 12-year-old, pay off any margin, and move the proceeds, slowly, calmly, into a low-cost index fund or a handful of businesses that actually mail you money. You won't catch the bottom, but you will catch your breath, and that's the first step toward recovery. The market rarely offers forgiveness, but it always offers another day and another price if you're willing to admit the mistake before it compounds. While you're at it, build a cash war chest, not because cash is king. Cash is actually a lousy long-term investment, but because cash is the only friend who never needs a weekend off when opportunity calls. I keep enough treasury bills to cover 2 years of family living expenses, plus a separate pile I think of as dry powder. When the next panic arrives, and it will, those piles let me buy without having to sell something else at the same time. People say cash drags returns, but I measure returns across a full cycle, not just the sunny half. The S&P fell 50% twice in the last 20 years. The investors who had cash lying around didn't just survive. They feasted on discounted quality while the leveraged crowd held fire sales in their front yard. Write your panic plan while you're calm, because calm doesn't ship with the crash. Mine is a single sheet taped inside my desk drawer. If the market falls 30%, buy more of the businesses I already like. If it falls 50%, back up the truck. Do not sell unless the business is broken. Do not watch financial television. Do not check prices more than once a week. I wrote it in 2008 after I caught myself staring at a red ticker at 3 a.m., and that piece of paper has saved me more than any analyst report. Your plan can be different, but write it down, sign it, and let your future terrified self remember that your past calm self was smarter than any tweet. Money troubles leak into marriage faster than water through a cracked foundation. I've seen couples argue over crypto losses they never discussed until the exchange froze withdrawals. And I've seen spouses discover foreclosures from a stranger knocking on the door. The antidote isn't bigger gains, it's smaller secrets. Sit down once a month, open the statements together, and ask, if we lost half of this tomorrow, would we still feel safe? If the answer is no, we need to be okay. Dial back the risk before the market does it for you. Your partner doesn't need you to be a hero. Your partner needs you to be present, solvent, and honest. A boring portfolio won't impress strangers on the internet, but it will impress the one person who shares your pillow, and that's the only shareholder who can fire you for cause. If you remember only one sentence from the next 20 minutes, make it this: wealth is the transfer of purchasing power from the impatient to the patient. And the easiest money you'll ever make is the money you refuse to lose in stupid manias. You don't need 100 great investments. You need a handful of good ones you never sabotage. Miss one bubble and you'll look foolish for a season. Chase every wave and you'll stay broke for a lifetime. The market will offer you another miracle story tomorrow, and the day after, and the day after that. Let someone else surf. I'd rather own the shoreline and watch the tide roll in and out, knowing the sand is still mine when the storm passes. Starting today, ask yourself whether you want to be another surfer wiped out by the next headline, or the quiet owner of solid ground that's still there when the waves are gone. Choose the shoreline, plant your feet, and let time do the heavy lifting while the tide does the rest.